Welcome to Pro News Weekly. Let's dive into the latest updates on the financial markets. The US dollar is storming ahead amid geopolitical tensions. Stock indices have bought back the dip, gold is recovering after the sell-off, and Bitcoin has gone on the offensive. On Wednesday afternoon, a New York Times report suggesting that Tehran had contact with the CIA regarding potential negotiations triggered the sharpest rise in Euro-USD in a month. The report prompted traders to reassess the possibility of an earlier easing of tensions in the Middle East. However, the US dollar soon regained strength after Iran denied the claims. The political landscape in Iran has become less cohesive, following the deaths of several members of the ruling elite. At the same time, conflicting signals regarding a potential blockade of the Strait of Hormuz are adding further volatility to oil and equity markets. Regarding the duration of the conflict, Donald Trump's administration is guiding markets towards a 4 to 5 week timeline. However, investors prefer to play it safe and are using the 2022 template, even though the protracted conflict between Russia and Ukraine disrupted oil and gas supplies to Europe. This drove up global prices and sparked a surge in inflation, including in the US, triggering the most aggressive rate hike cycle in 40 years, which strengthened the US dollar against its peers. The Fed is currently in a cycle of rate cuts, but has paused since December. However, the very fact of extending the pause in policy easing plays into the hands of Euro-USD bears, given the existing wide yield differential between US and German bonds. This is especially true given the growing signs of strength in the US economy. Published ADP data showed private sector employment growth of 63,000, the best results since July and above the forecast of 50,000. The ISM Services Purchasing Managers Index jumped to 56.1, its highest level since August 2022. With the US dollar strengthening against major peers, it is clear where to look for the next trade. The Buy Asia strategy, popular among investors after the Supreme Court canceled Trump's tariffs, was tanked by the armed conflict in the Middle East. The region is the main buyer of oil passing through the Strait of Hormuz. A potential slowdown in the global economy will deprive export-oriented countries, including China and other Asian countries, of the momentum they need. The flight from the South Korean and Taiwanese stock markets, which had performed impressively at the beginning of the year, breathed new life into the S&P 500. The flow of capital from Asia to the US, coupled with individual investors buying dips, kept the broad stock index within the medium-term consolidation range of 6,800 to 7,000 and pushed it towards the middle. Wall Street experts are sticking to their bullish forecasts of a 10% rally in the S&P 500 by the end of the year. In their opinion, the strength of the US economy and positive corporate reporting will allow the stock market to continue its upward trend. After a sharp sell-off driven by rising treasury yields and the US dollar, gold is stabilizing. The precious metal is experiencing serious difficulties due to the return of investor confidence in the US currency. Donald Trump's tariff policy and his attacks on the Fed cast doubt on the greenback. However, the armed conflict in the Middle East was another tough reminder that there is no alternative to the dollar. Investors took the February 2022 market reactions as a guide. From late February until September that year, gold lost about 19%. The idea behind the move was that soaring oil prices would fuel inflation and force the Fed to keep interest rates high. However, the longer the US, Israel, and Iran confrontation continues, the greater the chances of gold rising. Military action has blocked an important artery for the supply of physical assets. Unlike oil, which is exported by sea, gold is transported by air. The UAE is the largest intermediary, having about 20% of the world's refining and trading. So, this may soon lead to metal shortages in India and China. Rumors that Iran is ready to give up its uranium reserves, and Donald Trump's calls for Congress to quickly pass the Clarity Act, which is important for the crypto industry, allowed Bitcoin to break out of the 63,000 to 71,000 trading range. It had been stuck there for a whole month. However, improved global risk appetite and stabilized demand for ETFs allowed Bitcoin bulls to launch a rapid attack. Capital inflows into specialized exchange-traded funds focused on digital assets have been occurring for 5 of the last 6 days. Trump has accused banks of opposing Congress's adoption of cryptocurrency legislation. According to him, Americans should be able to earn more than they do now. Banks, however, are hindering crypto companies' efforts to offer higher rewards for users' stored funds. Support from the president and a rally in U.S. stock indices have allowed Bitcoin to rise from the ashes. Investors' attention will be focused on the Middle East and the White House's return of $130 billion in previously collected tariff revenues. The Supreme Court has noted to the American administration that this process has not yet begun. An early end to the conflict could revive interest in Asian purchases and seriously weaken the U.S. dollar. Conversely, continued military action with no signs of a truce will sustain high demand for the greenback as a safe haven asset. The main events on the economic calendar will be the U.S. inflation reports. First, consumer price statistics for February will be released, followed by data on the January Personal Consumption Expenditure Index, the Fed's preferred inflation indicator. So far, the surge in oil prices due to events in the Middle East has not affected the CPI and PCE. Nevertheless, investors will be watching closely for signs of acceleration in the indicators. If they appear, it could undermine the futures market's belief in 2 rounds of Fed monetary expansion before the end of the year. Follow the latest developments on global markets in Pro News Weekly. Like, share, and subscribe.